What's going on, everyone? Mark Roberta here. In this video, we're going to talk about 3 different ways to protect yourself from a stock market crash. So maybe you're thinking that a lot of bad stuff's happening along the horizon and you're looking at your investments wondering what's going to happen. And the buy and hold approach can certainly work, but if you do want to take some extra measures to protect yourself and earn some higher returns in the process, I'm going to share with you 3 different strategies that all involve options. And options, to sell options, which we're going to be talking about selling first, you do need to either have 100 shares right now, or you do need to have enough cash to buy 100 shares. All this will be a little bit more clear by the end of the video if you're not entirely sure how to use options. So the first strategy to protect yourself from a downturn is, rather than buying the company that you want now, wait for it to hit a lower price. Now, this is a very common idea of buying the dip, but there is another layer to this that you can get into with cash secured puts. So right now I'm looking at Pinterest, and I would love to enter at the $35 price point. The problem is that Pinterest, as of this video's recording, because I'm sure that it's going to get posted a few days after I actually do this video, but the way that Pinterest is right now is just a little too high, and it's not the $35 point. Now, you can set a strike price and just wait for the stock to hit $35, and then the broker automatically executes it for you. But you could also sell what's called a cash secured put. So cash secured puts, you need to have enough money to buy 100 shares of the company, and you put that all down. So $3,500 is enough to buy 100 shares of Pinterest if it hits $35. So I sell this cash secured put, and I instantly made $22 when I did it. You'll see on the screen that you will make $12 if you do it just based on what's there right now, since the expiration date is pretty close. I did this, I believe, a day before I did this recording, but you get paid to wait for the stock to hit the price. Now, at expiration, if the stock does not hit $35, you get your $3,500 and you get the bonus premium, which in my case is $22. If it doesn't execute and I don't get the 100 shares at my desired price, I will just sell one of these cash secured puts again and keep repeating this process until it hits $35 a share. Depending on what happens in between the expiration of this cash secured put, because I just don't think it's going to happen. In between all that and what the market looks like on Monday, I may say, hey, I want to do a cash secured put now where I buy 100 shares of Pinterest at $34.50, collect even more premium, and then save additional money, because instead of buying a stock at $35 a share, I'm buying it at $34.50. So only do this strategy for stocks you'd actually want to own, because premiums are going to look really juicy for a very volatile stock. So if you're thinking of a stock like Tesla, those have really juicy premiums because the stock could go down 5% on an Elon Musk tweet. It could go down 7% on a single article. Like, there is more that's going to happen to a stock like Tesla in the short term than something like Pinterest, and especially something like AT&T, which has very low premiums, but AT&T is attractive to a lot of income dividend investors. The second way to protect yourself from a market crash is to do covered calls. Now, for a covered call, you actually have to have the 100 shares. And the way a covered call works is you say that you agree to sell the shares at a set price and you get premium for that. So we're going to use Fastly in this example, which is a company I do own, and I'm a little like, it might go down in the short term, and if it goes up to 90, which is the strike price I set in this example, and I sell, like, I'm okay with that. You don't want to do this to companies that you are married to, and in any event, you don't want to be married to a single stock. You don't want to be too emotionally attached to it. So a stock like Fastly commands higher premium since it's a growth company, and a lot can happen with that company based on stuff with TikTok and just the overall potential for growth and meteoric rise to where it is now. So the way this protects you is you make the premium that kind of cuts into your cost basis. So it's not going to show it in your Fidelity dashboard or anything like that. But if you sell a covered call on Fastlane, you make $200 on that, and you bought the stock at $80 a share, then it cuts down to $78 a share, because that's $200 you're effectively making just by holding on to that stock. And if it doesn't hit the $90 strike price, you get to keep all those shares, you get to keep the premium, and you could do it all over again. Now, the reason that you want to do this for a stock where, if it hits 90, you're okay with selling, is because a stock like Fastly could get to $100, and then you still have to sell at 90. Just like with the Pinterest example, you set the price at $35 where you will buy. If it goes down to $33, you still have to buy it at $35. So when you're picking a strike price and you are interested in buying through a cash secured put, like having those 100 shares or selling the 100 shares in a covered call, set it at a strike price where you're actually okay with selling, rather than just for a juicy premium where the strike is right next to the current price of the stock and you actually want to be a long-term holder of that stock. So that's just something to consider. And as you do this each week, it does chip away at the cost basis. So maybe let's say you make $1,000 in 1 year from Fastly options, and now all of a sudden that's a $10 per share loss that you could afford. You still break even at that point because of all the money that you made from the premiums. And in a down market, the covered calls are less likely to actually go through, which means you will continue to keep those 100 shares and you will keep on being able to do those covered calls. Now, if you do a covered call that the stock goes a little bit above the strike price, you have to sell those shares, and you really want to get back into that position, you could do it with a cash secured put, similarly to what I'm doing with Pinterest, to get 100 shares of that company at my price rather than what the market is telling me that it is worth in that moment. The third strategy to protect yourself from a stock market crash involving options is to buy puts. A put pretty much gives you the ability to sell a stock at a certain price. So we're going to look at QQQ. That is it's an index fund that pretty much tracks NASDAQ. So if you want to get into NASDAQ and you want to be able to trade options as well, QQQ is the asset of choice. So when it comes to buying puts, it's a little different because it's more of like in insurance, it's protection. So if you aren't sure what's going to happen in the election, you're a little nervous about what can happen based on who's elected, based on what happens in the political sphere, you could buy a put that pretty much says, I get the right to sell my 100 shares of QQQ or whatever it is for, let's say in this example, $270 a share. Now, it does cost premium to make this happen. So when you're selling cash secured puts and you are selling the covered calls, you make the premium, but to buy a put, you have to pay the premium. And if the stock keeps going up, then your put's likely to expire worthless and all the money you put in just goes to zero. But if QQQ were to go down to like $250, $240, $230 a share, because there are some concerns people have about how much tech has gone and what the valuations look like. If it goes down to $230 a share, but you have the 270 strike for your put, then you are able to sell those shares of yours, the 100 shares, at $270 a piece rather than the $230 a piece that they are currently worth in the market. So it's a way where you protect yourself from that loss. And worst case scenario, I mean, there's a few different scenarios, but if the stock keeps going up, you keep getting that gain, you just lose that, you lose the money you put into protecting yourself. So those are some of the different options you have for leveraging options to protect yourself in the event of a stock market crash. Obviously, the best way would just to turn your whole portfolio into cash, but then you miss out on all the gains that can come your way. It's not like this is the first time you're hearing bubble. If you came across this video, you heard bubble before. Like 2016, there was supposed to be a big crash, a big bubble. That's something like the media was talking about. 2018, we had trade war, we had rising interest rates, which was the big concern. And now that's just based on what we're looking at for the next few years. Rising interest rates isn't the big concern at all. So you do hear a lot about potential crashes that can happen. Eventually, they do happen. It's not like you could have a bull run for all of eternity. So that's why it is good to protect yourself here and there rather than just not really do anything and then something hits the market and all of a sudden you lose a lot of value in your position. Stock market crashes, when they do hit, they hurt a lot. So it is better to look at your portfolio, think of how you're prepared for different downturns. The most basic advice would be to just hold on to companies that you feel really comfortable with, but there are some advanced ways, which some of them I've covered in this video, that can certainly help you in the event of the markets going a little out of whack. So in any event, I do hope you guys enjoyed this video. If you did, make sure you hit the like button, subscribe, because we'll be doing more of these, and I hope to see you guys next time.